Welcome to the new video. In this video I will try to explain selling insurance. It is possible, of course, for an investor to simply sell calls and puts, which is a kind of option trading. Probably you know what a call option is and what is a put option. If you don't, then I would request you to see my previous videos where I have explained those. So, investors can sell options. In other words, the investors can write an option with or without having a position in the assets. In this case, the stock, the assets are the stocks. Writing means selling. Thus, writing an option when there is a corresponding long position in the underlying asset is called covered writing. On the other hand, writing an option without having a position in the underlying asset is called naked writing. If we have a long position in an index, that is, if we buy a stock at time t equals to 0, and at the same time if we sell a call option, then this actions create a situation which is called covered call written. Buying a call option means I have the right to buy a stock at time t at the strike price k if the price of the stock at time t is greater than the strike price. That means I will have the benefit of buying a stock which is priced high, but I will buy that at the strike price. This is the meaning of buying a call option. But here we're selling a call option. That means the other party who buys the call option from us will have the right to purchase the stock at time t at price k if the stock price goes above k. So that's the opposite. We will be obliged to sell our stock at that price because we sold the call option for a premium at the beginning of the term. This covered call written strategy will just limit the profitability if the stock price increases at the maturity, because we will be bound to sell our stock at the strike price instead of selling at a higher price in the open market. However, the covered call written strategy will also protect us from extreme losing if the strike price of the stock decreases at time t, because at the beginning of the term we received a premium from selling the call option. If the price decreases, the buyer of our call option will not exercise his option, so that premium will offset our loss. So this is the graph. This is the graph of payoff from the stock. We can see it increases linearly, and this is the graph for the payoff of selling a call option. We can see up to the strike price the graph is constant. That means the payoff is constantly 0, but when the when the stock price increases, the payoff from the call option start to decrease linearly. And this is the combined payoff from the stock and written a call option. And this is the curve which we are looking for. This is the final curve. We can see that the red curve is the combined profit from selling a call option and holding a long position of a stock. So we can see that when the stock price increases, our profit is limited and it's constant. But when we can see that the price decreases, profit without written a call, the green curve, approaches to nearest to negative 30, whereas profit with written call, if the price goes to if the price decreases, the loss is minimized. That's how covered written call strategy works. Now if we have a short position in an index, that is, if we sell a stock at time t equals to 0, and at the same time if we sell a put option, then these actions create a situation which is known as covered put written. Buying a put means I have the right to sell a stock at time t at the strike price if the price of the stock at that time, t, is less than the strike price. But here we are selling a put option. That means the other party who buys the put option from us will have the right to sell the stock at time t at price k. If the strike price goes below k, will be obliged to buy that stock at the strike price because we sold the put option for a premium at the beginning of the term. This covered put strategy will limit the profitability if the stock price decreases at the maturity, because we will be bound to buy the stock at the strike price instead of buying at a lower price from the open market. However, the covered put return strategy will also protect us from extreme losing if the price of the stock increases at time t, because at the beginning of the term we received a premium from selling the put option. If the price increases, the buyer of our put option will not exercise his option, so that premium will help us to offset our loss. So that's the curve. That's the stock payoff when we have a short position. We can see the payoff constantly decrease when the stock price increases. That's the option payoff, and we see that the option payoff remains constant after the strike price. And this is the combined payoff graph, and this is the final graph which I would like to explain. So we can see that if the price decreases, profit without return put increases without any bound. So in this case we can make more profit. However, if the price increases at the maturity time, we can see that the profit without return put is less than the profit with return put. The red curve shows the profit with return put and the green curve shows the profit without return put. What does this mean? This means that return covered put option strategy protects you from extreme losing, but it doesn't allow to make extreme profit. Let's see the whole thing in Excel. So for a return call, so we will consider the same thing that we consider in our every example. Let the current price of the stock is 100 and interest rate over 6 months period is 2%, and selling price, in this case selling price of the call option is $7.4 and the strike price is same as the current price. So at time t equals to 0, since we buy the asset, so all the values, since we buy the asset, so the buying price will be negative since we are losing money from our pocket, and since we are selling the call option, we will receive the $7.4. So what is the total value at time t equals 0? Is just the addition of these two columns. So we will consider 11 different cases. So now at time t equals to 6 months, we will find the accumulated value. This accumulated value, this is negative because we already spent this amount of money. Times 1.02. That's the accumulated value. Let's consider 11 different stock price at time t equals to 6 months. So since we are in a long position, that means we are selling the stock, so we have a positive payoff from the stock, which is equal to the stock price. And now will the buyer exercise the call option? Let's see. If the stock price is less than the strike price, then the buyer of the call option will not exercise. So no, otherwise yes. So what is our payoff from the call option? It's our payoff. So it's we sold the call option. That means it's negative maximum of ST negative K. So this is the ST negative K fixed maximum of these two values. So it's 0. Now the total payoff. The total payoff is calculated from payoff from the stock plus payoff from the options. That's the total payoff. Now if we want to calculate the profit without selling the call option, we will have to do it in this way. So initially we spent $100 to hold the long position, to buy the asset. So this amount multiplied by 1.02, that means the interest earned during the 6 months period, plus the payoff from the stock is negative 27, and profit with selling the call option, this equals to the accumulated value of our initial investment plus the payoff from the stock plus payoff from the option. So we can see that from this Excel file, when the stock price decreases, our profit, loss, negative profit means loss, minimized. But after a certain level, the profit remains constant. Let's see how this works for return put strategy. So here again we are considering the same example. Current stock price $100 and interest over 6 months period is 2%. Selling price of the call option is $5.4 and the strike price 100. So both S0 and PP, that means the selling price of the put option here, sorry, it should be put option, it's a typing mistake. Put option, both are positive. Oh, sorry, 5.4, and this equals to 100 plus 5.4. Both are positive because in short position we sell our stock and receive the money, and we are also selling the put option. So we are getting two different installments, and this is the total value. At time t equals to 6, this amount will grow, and d9 times 1.02 using the interest rate 0.2. So that's the accumulated value for different cases. At time t equals to 6, let's consider we have 11 different stock price, which starts from 75 to 125. So buying price, since we are in short position, so after t equals to 6 months, at the maturity, we will again buy the stock to repay the stock from our friend from whom we borrowed the stock. So we will have to pay the money, therefore the payoff from the stock will be negative and will be equal to the stock price at time t equals to 6. Now will the buyer exercise the put option? Let's see. If the stock price is less than the strike price, then the buyer of the put option will exercise. That means yes, otherwise no. And what is the payoff? The payoff is just the opposite of buying a put option, that is negative maximum of K negative ST. What is K? K is 100, and what is ST? Or 0. So that's the payoff from the put option. Now let's find the combined payoff, which is equals to payoff from the stock plus payoff from the put option. Now let's calculate the profit without selling a put option. Like if we didn't sell the put option at the beginning, what would our profit at the end of the 6 months time? Let's calculate that. So initially we sold our stock at time t equals to 0 at $100. If we didn't sold that $100 amount will grow after 6 months times, and then plus the stock buying price of the stock, because we are buying at time t equals to 6. We sold at time t equals to 0, and we are buying back again at time t equals to 6. So that's the profit at time t equals to 6 months if we didn't sell the put option. So let's calculate the profit with selling put option. That's the accumulated value of our initial investment plus the combined payoff. So we can see here, up to a certain level of stock price, when the stock price up to 100, the profit from the combined strategy is constant. But when the stock price increases, the profit starts negative. Like that means we started losing money. But comparing without selling put option, we can see that these values here we make more loss. So profit with selling put option reduces our losses. So if we want to sketch this data, if you want to graph this, we can do that. Generally I do this using SPSS. So return call, that's the stock price ST payoff from the stock payoff, and the other columns. So if I want to graph these values, I use this chart builder. So double click on line, ST on the x-axis, and stock price, stock payoff on y-axis. Hit OK, and then we will get our graph. That's the graph. I hope this helps. Thank you everyone for watching.